Good morning, everybody. Hope you're well. Fish Food episode 11 here with Mark from Orca Finance. We've talked about rates for the last couple of weeks, rates, terms, etc. Common question we get asked a lot is what is the difference between hire purchase and leasing, or finance lease is the common form of leasing that we work with in commercial finance. Hire purchase, or HP, very tried and tested, traditional way of borrowing. Been around for a long time. You're probably familiar with this on car finance you may have taken privately, and it's the most popular form of funding. In fact, I was looking at our figures for the past 12 or 18 months. I think 63% of the business that we've done has been hire purchase, and then a percentage of lease and loans and things like that. So with hire purchase, you take the cost of the goods. The loan is secured on the asset, you're paid over a fixed period, usually at a fixed rate, and at the end of that term, you just take ownership, clear and simple. It's a purchase agreement rather than a lease or a rental agreement, so that asset goes onto your balance sheet straight away. You write that down through your accounting processes, and at the end of it, that asset belongs to you. Leasing, on the other hand, or finance lease, is more of a rental arrangement. You find it more commonly with goods that you are looking to use rather than own. With HP, if you had, like, say, a truck or a vehicle that you were looking to keep for 5, 6, 7, 8, 9 years, you probably want to own that and then sell it at the end of its life, its useful life. With leasing, you might just take some IT equipment or something similar to that, put it over a 3-year period. Lease agreements do tend to have a lower initial outlay, maybe 3 or 6 rentals in advance. It is usually off your balance sheet as well, so there's some different tax treatments for it, certainly some different VAT treatments as well, and it can be advantageous to lease for that reason as well. But at the end of the agreement, you do not usually take ownership of that asset. The leasing company will often require you to find a third party to sell it to, and there may be a process where you keep a percentage of the sales proceeds, or you may pay a secondary rental or a peppercorn rental and keep renting those goods from the leasing company. Both legit, both viable ways to fund assets in your business. But if you deal with a good broker, they'll be able to give you some guidance on what might be the best route for you, present you with all the right information. But generally speaking, one is something that you want to own, one is something that you want to use, and you have to make a judgment call based on those factors. Costs, rates, interest pretty much mirror each other, really. So it's not that one's cheaper than the other or one's better. It's just what suits your requirements and how you want to treat it for tax and VAT. Hope that's been helpful. Tune in next week, episode 12, I think that will be. We're really motoring now. See you soon. Cheers.